Ladies and gentlemen, there are moments in financial history when the entire world seems to pause. Television screens glow red. Mobile notifications begin to flood in. Stock prices fall sharply, and investors everywhere begin to feel the same emotion. Uncertainty. Some feel fear. Some feel regret. Some feel anger. And some feel confusion. They ask, what is happening? Why is the market crashing? Is this the end? But before we answer that question, we must understand something important. Markets do not crash randomly. They do not collapse without warning, and they do not destroy value without reason. A market crash is not just a financial event. It is a reflection of human behavior. It is a mirror of collective emotion. And it is part of a cycle that is repeated again and again throughout history. If you truly understand why markets crash, you will stop fearing them, and you may even begin to respect them. Part 1. The market is a voting machine in the short term. In the short term, the stock market behaves like a voting machine. People vote with their money. They vote based on excitement. They vote based on news. They vote based on rumors. They vote based on fear. Prices move not because a business suddenly changed overnight, but because opinions changed. If millions of people believe tomorrow will be better, prices rise. If millions believe tomorrow will be worse, prices fall. But beliefs can change very quickly. And when beliefs change rapidly, crashes happen. The key thing to remember is this. In the short term, markets are emotional. In the long term, markets are logical. But crashes happen in the short term. Part 2, the seed of every crash is greed. Every crash begins during prosperity. Not during weakness, not during crisis, but during growth, when the economy is strong, when unemployment is low, when companies report record profits. When everyone feels confident, that is when risk increases, because confidence slowly transforms into overconfidence. Overconfidence turns into speculation. Speculation turns into bubbles, and bubbles eventually burst. When people begin investing not because they understand value, but because they fear missing out, the foundation becomes weak. When conversations shift from, is this business strong, to, how fast can this stock double? The cycle is maturing. Prices rise beyond reasonable expectations. And when expectations become unrealistic, even small disappointments feel catastrophic. That is how crashes begin. Part 3, the role of valuation. Valuation is simple. It asks, what is this business truly worth? But during strong bull markets, valuation becomes ignored. Investors focus on momentum. They focus on recent performance. They focus on price charts. Instead of analyzing earnings, cash flow, competitive advantage, management quality, long-term sustainability. When valuation disconnects from reality, markets become fragile, and fragile systems break easily. A crash is often not the cause of damage. It is the exposure of damage that already existed. Part 4. Triggers are not causes. Many people blame crashes on specific events: a war, a pandemic, a banking collapse, an interest rate hike. But these events are usually triggers, not root causes. The true cause is imbalance. The event simply reveals it. Imagine a building with weak foundations. It may stand for years, but one strong earthquake reveals its weakness. The earthquake did not create the weakness. It exposed it. Similarly, crashes expose excessive leverage, unrealistic valuations, and emotional investing. Part 5, the power of fear. Fear is contagious. When prices drop 5%, some investors become uncomfortable. At 10%, they become anxious. At 20%, they panic. And panic spreads faster than any virus. People begin selling not because they want to, but because they feel they must. They imagine worse scenarios. They assume decline will continue forever. They forget history, and fear feeds itself. When more people sell, prices fall further. When prices fall further, more people sell. It becomes a loop, a downward spiral. And that spiral is what we call a crash. Part 6, leverage, the invisible accelerator. Leverage amplifies everything. If you invest with borrowed money and prices rise, profits multiply. But if prices fall, losses multiply faster. Investors who use leverage cannot afford patience. They are forced to sell when prices decline. That forced selling creates pressure, which pushes prices down even more, which forces even more selling. Leverage turns small corrections into violent crashes. And in modern markets, leverage is everywhere, from hedge funds to retail traders. From derivatives to margin accounts, it is a hidden risk that only becomes visible during crisis. Part 7, media and social amplification. The media does not create crashes, but it amplifies emotion. Negative headlines attract attention, and attention fuels anxiety. Social media accelerates fear. One rumor spreads instantly. One viral post triggers thousands of reactions. In previous decades, information traveled slowly. Today, fear travels instantly. This speed intensifies market reactions and makes crashes feel faster and more dramatic. Part 8. Economic cycles are unavoidable. No economy grows forever without interruption. Expansion leads to excess. Excess leads to imbalance. Imbalance leads to correction. Correction leads to renewal. This is the rhythm of capitalism. Boom, bust, recovery, growth. The mistake investors make is believing this time is different. It rarely is. Technology changes, industries evolve, but human nature remains constant. And as long as humans participate in markets, crashes will occur. Part 9, who suffers most during crashes? Those who invest emotionally, those who chase trends, those who invest money they cannot afford to lose, those who misunderstand risk. Crashes punish overconfidence. They punish speculation. They punish impatience, but they reward discipline. They reward liquidity. They reward long-term thinking. The difference is mindset. Part 10, what smart investors do differently. Smart investors prepare during good times. They build cash reserves. They avoid excessive debt. They buy quality businesses. They focus on intrinsic value. And when markets crash, they do not celebrate, but they observe calmly. They ask, has the long-term story changed, or is this temporary panic? If fundamentals remain strong, lower prices mean higher future returns, but only for those who remain rational. Part 11, the greatest advantage, time. Time is the most powerful asset in investing. If you are forced to sell tomorrow, you are vulnerable. If you can wait 10 years, you are powerful. Market crashes hurt those with short horizons. They reward those with long horizons. Time smooths volatility. Time heals fear. Time rewards patience. Part 12, history's message. History tells us something very clear. Every crash feels permanent. Every crash feels unprecedented. Every crash feels like the end. And yet, markets recover. Businesses adapt. Innovation continues. Growth resumes. The question is never, will markets recover? The question is, Will you remain invested long enough to benefit? Conclusion: the truth about market crashes. Markets crash because humans are emotional, because greed pushes too far, because fear spreads too fast, because leverage amplifies risk, because cycles are natural, but crashes are not enemies. They are reminders. They remind us to respect risk. They remind us to value discipline. They remind us that patience is powerful. And they remind us that long-term thinking wins. If you understand this, you will not fear the next crash. You will prepare for it. You will survive it. And perhaps you will grow because of it. Thank you.